In the near term, India is one unique market in power, power, because the power demand is growing and the country is transitioning from thermal to renewable source. Currently, more solar and wind. I think that is the biggest story for now. And you would have seen that a lot of private companies are into that space, which are putting up solar plant, wind power plants, and also round-the-clock power, which is a hybrid of solar and wind. Sure. Also, the usage of batteries is increasing. I think there's a lot of exciting opportunities in the renewables space because the power capacities are going to grow there significantly for next 3 to 5 years.
I do want to understand from you, Rana, how are you feeling about the market and the fact that it's slowly grinding lower? We had Praveen Jagwani from UTI International yesterday say that there is more downside that is to open for the markets, and maybe during the mid of 2025, that's June, July of 2025, there would be an entry point to get back into the markets, because right now domestic investors are also being a bit wary about growth prospects and earnings prospects.
Sure. So I was recently in India, and I would say that domestic investors, they kept pouring money, they kept buying the decline, but it's been 4.5 months and the market's been grinding lower, so their spirits are a bit down. But I have to say this all depends on the flows, the foreign outflows, is impact after effect the foreign outflows that has happened. See, over the last 4.5 months, the foreign outflows are $20 billion. It's a significant number. And this has happened.
But that is more tactical, right? If, foreigners are not selling because they're giving up on the India story.
Sure.
They're selling because China looks more cheap, so they want to redeploy there.
Sure, I think that's correct. And I think that kind of fortifies the case that I'm going to lay out. See, the foreigners sold from India $20 billion. China looked attractive. China gave us stimulus sometime late September, early October. Indian earnings slowed. Indian earnings slowed as a result of the tighter fiscal policy and tighter monetary policy. Now let's look at those segments. The fiscal policy remains tight, but as you're aware that there has been a significant stimulus for consumption that is given. So I think that area of the market should do well. And secondly, RBI is now ramping up liquidity and cutting rates to boost the credit demand and growth. So I think that should play out over the next 3 to 4 months. In the very short term, given US dollar and US tariff tantrums, there can be volatility. But in our view, after 15% correction, this slower earning growth is now in the price. The valuation has returned to the average. So going forward, on the balance, on the other hand, the growth, the confluence of positives that is building up, which is the tax cut, RBS policies, rural growth showing some of revivals. Those are not so much in the price of the positioning, but that will take 2 to 3 months to play out.
2 to 3 months to play out. So what happens next? I mean, what are you advising clients in terms of where are you deploying cash in India right now? Where are you going overweight? Where are you underweight? Where are you taking profits? How are you rebalancing your portfolio in India?
Sure, that's a very important question. In fact, I think throughout last year, we kind of highlighted that we were cautious on the industrial side of the market. And that's because of a view that capex-led growth cannot continue for a long time. And that has what playing out. So I think for India, there's a significant policy pivot from capex to consumption, and the portfolios have to reflect the same. In that milieu, I think we like auto stocks, we like retail landlords, because retail stocks are quite expensive. We also like large consumer finance companies in the unsecured space as well as the secured rural space.